Good afternoon, everyone. We were just discussing that the post-lunch session is probably one of the most difficult sessions to moderate because everyone's kind of in a food coma. But I hope you have enough appetite left for some of the discussions that are to follow, because we are going to be talking about different investing avenues when we're talking about India becoming a $5 trillion economy and raising the finance for that. And I have with me Mr. Prateek Agrawal, who's the MD and CEO of Motilal Oswal AMC. And they deal with a lot of the funds that we will be needing for this growth. And if I was to sum up some of the morning sessions, we had some takeaways like India should move from being a savings economy to an investing economy. And we need more encouragement for people to invest. We need more risk appetite. We need people taking bigger risks. And I think that was one of the key takeaways from the morning session. So starting with that, Prateek, if I was to come to you, mutual funds are considered a relatively safer investment strategy compared to directly trading in equities in the stock markets. I mean, these days you see a lot of retail investors jumping into the stock market, especially when it's at the peak, right, and burning their fingers. But again, the returns from mutual funds versus the equity markets may not be that significant. So we are talking about the concept of growth investing, and that's something that you have been spearheading. How does this straddle the two? What kind of risk appetite are we looking at from investors here when it comes to growth investing?
I will try to answer that. Now, see, in investing, you always start with a belief. Some people call it philosophy, as to why do stock prices move up, right? If it is because the underlying business is becoming bigger, larger, more profitable, more high free cash flow generating, the value of the business is expanding, and over time markets will reflect it. That is growth investing. Okay. Now, if you are with your philosophy, then you are doing what is right. It is not risky. But in our market, what happens is that there is a market indicator, a Sensex or a Nifty, and risk is measured versus an index. That might make one look more risky versus the other. Okay, is something that people need to understand a bit. Now, we say this is time for growth, this is time for alpha. Just understand this, I'll give you examples, very simple ones. In 90s, what do you want? You want a space where there is large growth sustaining for multiple years. Okay, in the 90s, you got that from software, for example. So in an otherwise old economy kind of a construct which an index had, you get a new space, software, and any time over 92 is when I think, or 93 is when Infosys listed, to 2000, you boarded that train, people made large excess returns over Nifty. Okay, similarly, private sector banks, did it for 20 years, early 2000 till 2020 and so on. In the same manner, if you see, there are so many new spaces that have happened in the market which were not there before. So, come to think of it, 5 years back, probably there was no mutual fund listed. Now, we are talking India moving from being a country of savers to country of investors. Wouldn't you expect, so asset management to asset management, debt versus equity, don't you think mutual funds will grow faster versus the averages? Now, similarly, there was no renewable listed in the market. There was no new tech listed in the market. EVs were not known. People were skeptical and so on. And you get the drift. There are just so many new things which are happening, companies coming of age and coming in the market, that there are a lot of spaces where a combo of solid growth sustaining for long period is available. And we say this is reason for expecting excess returns in the marketplace and food for growth investing. Growth investing also gets tailwinded when interest rates are low, inflation is low, money supply is better. Something that during the course of the day, I think most people would take home. This is what is happening. So that is what it is. Very simple. But then, if you compare our construct with that of the index, since index represents averages, larger companies, right? We in our business call it tracking error, very large tracking error, over 90%. So our construct should not be expected to be with the index. They will be on both sides.
Okay.
And hopefully, if the philosophy is correct, over time, outcomes should be good. That is basically how it is. So we say expect volatility. So as an example, I can give you two indices. For example, you look at a S&P 500. You look at a NASDAQ. Not a perfect example, but you take any 3 to 5 year block and have a worst starting point, which is just before the tech bubble burst, till now, yet you will find a NASDAQ which is more representative of what we do, innovation, higher growth kind of stuff, having delivered better returns versus an S&P 500, but with more volatility.
Okay. Right. But when you're looking at a growth investment strategy, and I'm talking about your portfolio management, portfolio managed services, your PMS thing, you look at very limited stocks. So how do you allocate these stocks? How do you pick which ones are going to go into the basket? Yeah.
Yeah. So I'll take some time trying to explain that. What do we see ourselves as? See, today, if you ask any investor how many funds you hold, 8, 10, 12, 15, right? If you look at the construct of the fund, you find ours short, which means everybody else is longer, and then think of it, you are holding 10 funds. You own 500 to 600 names. Okay, you are paying active management fees. Think of an investor, paying active management fees, trying to own the index. Cheaper way to do it is to buy a index fund. Okay, so see, running long portfolios is one thought if you, for example, are the only fund an investor is buying. Else, by doing that, you are making the investor over-diversified. So we see ourselves as one of the component of maybe a large one, our wish is a very large one, but a component of a client's portfolio.
Okay.
If you think in a client's portfolio, actually 50 names is good enough, but 60, 70 names is good enough, we say have us on the growth side, pair us with the best of value. Today there is no value manager who manages less than 70, 80. Yet your portfolio gets completed in, let's say, 100 names. Still chance for alpha versus having everything, come into your portfolio through one manager or the other. That is the difference. We don't see ourselves as whole of somebody's portfolio. Unless the guy is happy to, go through the variations along the way.
Put all his eggs in one basket.
Yeah. So very different positioning, thinking the client as to what his issues are and then building a product for that client. And we are saying, expect volatility. So we are saying, look at us as something which is volatile. But if we do our job well, if the philosophy is right, look at the earnings growth quotient of our portfolio, you will find it to be very different from anybody else.
Okay. So what are the sectors that you actually look at?
Let us do it by exclusion.
Okay.
मजा आएगा उसमें. कुछ लोग शायद जाग जाए. After a good, nice lunch was very good. So, what does a growth investor seek to do? Make excess return through growth. So, simply put, if index is supposed to grow at 12%, which is what it has done over a long period of time, you build in 3 to 4% excess returns, which will make us look good over 3 to 4 years. 3% more over 3 years is top quartile. You build in fees, you build in errors, omissions, and you build in some amount of valuation compression. So, क्या होता है? Your start point of growth of a compounded nature, not one period, I say 4 dots, is 20%, 21%. Okay. Now, think of spaces which will not do it. Okay, so will Staples do it? Try and find it in our house, practically zero. Will banks do it? In some constructs, we may have some banks, but typically zero in many. Large IT do it, we have zero in the house. Will commodities do it? We have zero in the house. Will ICE vehicles do it? We have zero in the house. When I say zero, close to 0x of our large cap fund, that is how it is. So these are spaces which will not give you what you want, right? Spaces like new tech, will it give you that? Renewables, will it give you that? Defense, will it give you? Spaces which are benefiting from Make in India, will it give you? Luxury, will it give you? And you get the drift. So our portfolios are positioned super sharply for spaces which we believe will grow strongly for several years, which is the crux of, trying to get superior outcomes. So this is what it is. So I gave you exclusions.
Right.
And then you get the money to put into newer spaces. Now it helps that we are of the size that we are, because the kind of growth that we seek is not really omnipresent. So if somebody is very large, very difficult for them to find these niches. We are probably of a good size to be there. So that helps. So this is how it is. So we believe our constructs may be some of the highest growth in earnings constructs in the country.
Okay. So in the morning sessions, we were talking about, having more investors getting into the country, like we were saying, from a country of savers to a country of investors. And some of the places where they can actually start off is with, small mutual funds, small cap, mid cap, will give them sustained returns. But how would you compare a mutual fund investing strategy versus a PMS, or for the few who go, the retail investors directly in the market? How do you compare what they should probably start off with if I was to just take an average Indian investor?
No, so I run a
Classify the
business.
risk appetite like for
me. I run a business, so it's so easy to say come to us. But, dispassionately, if you belong to a industry, suppose you belong to software. Software is a large industry in the country, a lot of people employed. Now, a lot of them will know more about software than we would know. Similarly, let's say take any other industry, automobile, cement, etc. So if you are dabbling by yourself, if you do it in these spaces where you are more knowledgeable, chances of a superior outcome is better. Now, you can be in one industry, but you can have friends in 3 industries. Form a group, outcomes can be even better. So if you look at individual investors, you see groups, you almost never see one. Groups always help, exchange of ideas. When times are weak, you hold each other's hand and outcomes are better. But don't try and get into, spaces that you don't know about. Listening to somebody, because you may get in listening to somebody, na Abhimanyu Chakravyuh mein ghus gaya, nikalna nahi aata tha. So you won't be able to get out, is the issue. So that is my thought. Now, mutual funds are great vehicles. So suppose you can do X percentage on your own. Now, every time you buy and sell, there is a tax incidence. Mutual funds are the most tax efficient vehicles in India. So, with all the drags that we have, fees, inefficiencies, etc., we compete very well with most average investors, maybe even better than average investors. Because, let's accept it, regulators have been kind on us on taxation. Now, coming down to PMS, so for most people, mutual funds are good enough. If you look at spectrum of products that mutual funds offer, most of the need of most of the people can be satisfied. In fact, some of our mutual fund constructs may look superior to most of the PMS AIF constructs. But PMSs, AIFs in particular, allow you to do things which, for example, mutual funds cannot do. So, let's say giving you a whole range of exposure to unlisted. Now, we have some of those constructs. So, in market, it is liquid, and liquidity has its premium. So, if you decide to get into something which is not listed, maybe a year before listing, maybe 2 years before listing, and obviously you will hope to get it at significantly better valuations. While it can up the risk content, yet the outcomes can be vastly superior. So our experience shows that. So those kind of products are very unique products which alternates offer. For investors, once they have most of the needs are taken care of by the mutual funds for that last 15-20% of their capital allocation, they can definitely look at alternates. Alternates can be crafted much better. Their positionings can be very different. It is very easy to communicate that this product should be seen as core of your equity portfolio, for example. So when you think core, you think lower volatility. So I'm not talking of myself, somebody else. Lower volatility. How do you achieve it? Now, for example, by buying highest quality businesses which have a good, nice, steady gradient of profit increases, no leverage on book, no leverage on promoters, no, anything that causes volatility is not there, less there. And then you are not competing on returns. You are competing on an attribute. You are marketing that attribute, getting the client who wants that attribute. All of that is possible on an alternates platform versus a mutual fund platform, which becomes, one can do it, but it's more difficult.
Okay. Just one last question, and maybe I'll take one question from the audience as well. The sustained interest that you're seeing in the equity markets in India, like retail investors, every time the market peaks, you get a whole bunch of people getting in, burning their fingers in the market. And this has banks worried because savings are not that much, and deposit growth hasn't been that high compared to the interest in the equity markets. How does one strike a balance over here?
No, so this is not entirely correct. If somebody trades in the market, money doesn't leave banks. So you sold, I bought, and both of us has an account in HDFC Bank, for example, money stays in HDFC Bank. In fact, since you can't transfer from fixed deposit, you will put it in savings. So the cost of money for the banks reduces.
Okay.
So more market activity actually reduces the cost of money for banks. So it is not that we are competing with them. It doesn't change anything for them, if nothing better.
Right.
Costs don't increase either because all of it is digital now. Where competition comes in is for using that money. If equity markets are good, nice, happening, and the whole ecosystem of private equity, venture cap has emerged, then banks find it more difficult to lend, especially at rates which they have been doing and at terms at which they have been doing. So, it's a different discussion, but the terms can be very onerous, and that 4% NIMs, exist only in the US probably.
Right.
So this is proved stable for so long. If the terms for the borrowers improve, obviously, borrowers will go more to the banks, or if they want deposits, increase the rate so that the investor which is going to equity markets don't go to equity market.
Right.
So it is a competitive this thing. Earlier banks were protected, now they are less protected. So that is the change.
Okay. Any quick question from the audience? Otherwise, we can wind up because we are out of time right now. We have one question from the gentleman there. We'll just take that one question and then we'll wind up. Can you get a mic to him, please?
In a recent SEBI circular, the fund managers were told to put their skin in the game before it was not there. So can you hear me?
So in the recent SEBI circular, the fund managers were
told or were instructed to put their skin in the game, in the funds. And related question is is the expense ratio should be proportional to the return that fund make?
Sorry, we didn't get the last.
No, so I'll tell you, the rule is a fund manager, if he is managing one fund, 20% of his net after tax goes into his fund. Fair? If he manages two funds, then 20% of his net after tax goes into both of those funds in proportion to the size of the funds. Correct? Somebody who is in a supervisory function, okay, and looks at several funds, 20% of his ex of tax goes into all of those funds in the ratio of the size of the fund. Sir, बैंकर्स को भी बोलिए ना करें, जितनी भी लेंडिंग उनने की है सब जगह अपने भी 10-10 हज़ार रुपया लगाए ना.
Actually, we are out of time and we can take other questions offline. So I'd like to thank Prateek so much for this.
Chalo, thank you so much.
Thank you so much for joining me.